Hey, welcome back. Since I looked into a few agriculture companies before, I decided to have a deeper look into a sector that's pretty much essential for food. This isn't food for us directly, but it benefits from the same population trends, supply chains and so on, and nowadays you can't really have one without the other. Now, the fertilizer industry is expected to grow by about 40% from 2020, which was a low year due to the pandemic, to 2030, so very slow. This is not lithium or something that would see a demand jump year over year, it's a very stable and slow industry. The commodity, however, can be volatile like any other commodity. There will always be some supply chain disruption or drought or anything related to nature that can push it up or down in a relatively short amount of time. What happened in 2021 and 22 was an exceptional event because it affected both Russia and Ukraine on top of the pandemic, which are actually key players both in the food and especially the fertilizer markets. Seeing this kind of prices again is extremely unlikely, so keep that in mind when you look at industry averages in the future. I think some long-term growth on top of the normal food or population growth will come from hydroponics and vertical agriculture. This is basically many times higher production per square foot with a much higher flexibility since you don't depend on the land and the environment. It doesn't matter how you plant it, potash is still an excellent source of a crucial nutrient that can have great effects on the production. In fact, you might even need more potash because in water-based agriculture you don't have the soil that has a naturally present potassium. So something that I think is a must-have as soon as possible for any human society will also need a lot of potash. I talked a bit about this before and I honestly have no idea why we don't use this a lot more than we currently do, other than big agriculture and stuff. This is a close to 100-year-old technology that's literally the future and we starve and barely use it. It would also make land cheaper, by the way, since you don't need that much space. Now, food and specifically crops are a bit of a different commodity than iron or copper because they don't depend that much on China. We are talking about something like 5 to 10 or 15% of global imports for corn, wheat and other crops because the country produces a majority of what it needs. But they still need a ton of fertilizers, or obviously more. The country is actually the #1 consumer, followed by India, Brazil and the US, using more than twice what the United States does. But importantly, food prices are also a matter of fertilizers and the other way around. One thing affecting or benefiting one will have a similar effect on both. That's especially because you have speculation in the market. If fertilizers go up, for example, then the cost of producing food will go up, but you then affect the consumer, you have inflation, demand issues, and eventually the price goes down and the other follows. It's obviously more complex than this because you have other factors including government subsidies, taxes and more, but this is a very simplified summary of something that happens over many years. Now, Nutrien, they make potash, nitrogen and phosphate products with production operations in Canada and the US. We see them following the price of potash pretty well, but overall not being an extremely volatile stock. We see this trend of rapidly ramping up the capex during the good times when everyone was making money, and now they begin cutting them back. It's normal behavior, especially for commodity companies, and it doesn't mean they have an issue, and it's actually a big contributor to the cycle. Higher prices means more money to spend on ramping up the production, leading to more supply in the future, which can then affect the price. We see them even mention selling record volumes, but being affected by lower prices, and now they talk about cost savings. Then the price falls, companies have issues, they close production facilities, and the cycle repeats. They can make around 2 billion on average, which is not bad for a 20-something billion market cap. I think these companies are very simple and straightforward to value. It's more about the kind of return you would be happy with. Today, for example, do you want around a 4.5% dividend and maybe potential for around a 2x in good times or a 50% drop in bad ones? Based on this, you can also make dividend and profit projections. Of course, it's not going to be perfect and there can always be dividend cuts or increases, recessions, spikes, growth and so on, which are unpredictable, but you can generally understand when this is cheap or expensive. In general, commodity companies are very predictable compared to high growth tech, for example, and don't get me wrong, you can never perfectly predict this stuff. Financially, we currently see a good position with the current assets covering the current liabilities and more than enough assets to offset the debt. There is about 25 billion in equity on a very similar market cap, which is not bad. This is, again, a good indicator of when you can call it cheap or expensive. Do you want to pay a fair price for the net assets like today or get them at a, let's say, 30% discount? They pay a roughly 4.5% dividend, meaning a bit over 1 billion. I'm not really that big of a fan of how they distribute the profit, however. We see a stable and growing dividend, and the extra money that they make during the upcycle goes into buybacks. I think that's actually a terrible policy because they basically bought stocks at 2-3x the current price instead of giving you another 10-20% per year like other companies do. Especially for a commodity stock that you probably don't want to sell during the upcycle, paying a dividend based on the company's performance instead of a fixed one is many times better. Imagine if you bought in 2019, for example. The stock went nowhere today and sure, you got some 20% dividends in total, but you could have probably gotten double or triple that much if they didn't waste the money on buybacks. Not only that, but if you wanted to add more of this, you'd have paid more and already be down today. For a commodity stock especially, there are certain times for buybacks and it definitely wasn't that. So quite a good company and a pretty good way to get exposure to the industry. I'd say this is currently around a fair value, but there are better options as you are about to see. The main deterrent, I guess, is that dividend and buyback policy. If it was only dividends and no buybacks, then this would have definitely been a good option for me. Good financials, good profit throughout the cycle, and overall a very solid company. But I feel like you miss out on too much due to buybacks unless you want to trade it. You know, this could have been like a variable interest bond that was amazing if bought during the bad times if it had a dividend policy based on a percentage of the profit. Riskier, of course, but still. It's a bit of a shame and wasted potential in my opinion, but this can change and until then we have better options. Now Mosaic, this one has fertilizer operations in the US, Canada and Brazil. The stock again followed the commodity very well and now they are back to around 2016 prices, meaning some of the lowest in about 2 decades. We see again a 200 million capex reduction in this case, but they were also affected by 3 hurricanes this year. This is another risk to keep in mind because they depend on the physical operations and any flooding, hurricane or even just issues on the main road can at least represent delays in profits. I remember a platinum miner a couple of years ago basically had the production trapped until the road was fixed. And when you depend on oil or some contractors coming and so on, you can lose many days of production. They include 2 graphs that show very well the effect of supply and demand. As the war began, prices even 5 or 6x'd in some regions, and this had a massive effect on the global economy because food prices were also affected. But now as commodity prices get back to normal, they also report significantly lower numbers. We see them getting back to making around 400 million, which is on the lower side of what the company can do. If the prices stabilize and the capex goes down as they plan, this can probably make around 500-600 million. That for an 8 billion market cap is quite bad, to be honest. Sure, it's not bad for them if you base it on historical prices, which can mean nothing, but looking at competitors, that's pretty much twice as expensive. As a result, the dividend yield is also low, around 3%, because they simply don't make enough to pay more. A positive about it that I have to mention is that this dividend is at least variable and in good times on top of buybacks and higher dividends, they also pay the special one. But still a low yield because of the inflated stock price. Financially, we see an okay position with the current assets covering the current liabilities and a lot of assets to offset the debt. As a result, we see 12 billion in equity, which is, however, a lot for an 8 billion market cap. What they can do if they are smart is take advantage of this valuation and buy other companies using the stock. Again, when you are valued at 20x the cash flow and you buy a competitor valued at 10x, you basically print $2 worth of production using 1. The return is incredible plus potential synergies. So not a bad company and they make good money, are pretty healthy and could develop a lot if they play it right, but you really overpay for not that much. If they can fall like in half, sure, it would be an okay pick, but that's a lot to ask for. Maybe if the commodities continue to fall and we get into the lower points of the cycle, this could fall enough, but even then, I feel like we have better options. It's more a risk and a lower dividend because of the price, and if they don't use it to grow, it's just a risk, no upside. Not to mention that it makes them less attractive for a potential buyer. Keep in mind that this is a pretty small company overall, and such an acquisition can offer a lot of value for a producer, for example. Now, FMC, this is an American chemicals company, so kind of adjacent to fertilizers, with a very diversified revenue by region and crops. We see a majority of the money coming from insecticides and herbicides. As a parenthesis, in case of vertical agriculture, the use for something like this is minimal to even zero, so that's actually a threat, not an opportunity. So, long term, the future of this industry is kind of questionable, so the company will have to adapt. We see them following the price of the commodity quite well, with a significant crash throughout 2023. They can make around 400-500 million on average, so a 7 billion market cap now isn't the cheapest even after a 60% crash from its peak. There is a global restructuring and cost reduction plan, which is a normal response to the current environment. Again, it's cyclical, and this kind of action from pretty much everyone will play a role in the future upside. Financially, they are in a good position, with the current assets covering the current liabilities and not a lot of debt. But once again, you have to pay quite a bit for the equity, and if you look into it, the assets aren't really that great. This company relies on R&D, formulas, brands, IPs and so on, so they are very different from the other companies in the video. This is why they barely have capex, but we see a lot of R&D, it's just a different business model. But at the end of the day, the balance sheet is not a reason to call them cheap, it's maybe around a fair value in this environment. So it's not exactly a fertilizer company, but we'll look into them anyway since they are related. Now, in this kind of industry, you have a higher risk of lawsuits, both from and against them. We can see them being involved in a lot of patent infringement lawsuits, although I think a majority of them are in their favor. But another issue is that they basically sell poison, and if there is any link to that causing cancer or something, this can cost them for decades. Look at Monsanto, who had to pay over 2 billion for something similar this year. 2 billion in the wrong environment is enough to bankrupt FMC. You know, say they are at the bottom of the cycle when they get hit by such a fine or lawsuit. Sure, issue debt for it, but then they can rapidly get in a spot where they can pay back the debt and the interest adds up. Even if they cut the dividend, there is the risk that it wouldn't be enough. And let's say it is enough, what do you buy this company for? Nothing gets back to you, barely anything is reinvested in the company, and pretty much all they do is to pay such a fine. So this would make it a really bad investment. The dividend, by the way, is at around 4%, so around 290 million. That's currently sustainable, especially since they expect around 400-500 million in cash flows this year. You'll see throughout the video that this is a very, let's say, average dividend in this industry today. This company is generally more stable since they aren't really a commodity producer, so that 4% is relatively safe. With the competition, you can see the profit drop in half overnight, so this might be an advantage for some people. But overall, I don't really like it. They aren't terrible, but the future of this industry is not that good and also comes with inherently more risk that can really affect the company. Getting this for a 4% dividend is not really attractive. Maybe if it drops to 6% or something, sure, but for now I think there are much better options. And even if it drops, the better options might also follow and become even better. Now, SQM, this is a South American company that's actually a leader in many commodity markets. They have operations especially in Chile, but also Australia and China recently. With this one, you have not only potash and other plant nutrition, but also one of, or actually the largest lithium company on the planet. They can produce it at very low prices and recently expanded the production capacity like all the other lithium companies. So this is a matter of several commodities, but it's definitely an interesting package. It's actually quite a unique combination to have the volatile lithium with the relatively stable growth potash and the rest. I have videos about lithium companies and even one dedicated to just SQM if you want to check it out from that point of view. Just remember that this can be an extremely volatile option thanks to the lithium exposure. This also comes with significant royalties to the state, but it's also a competitive advantage because the country isn't allowing just anyone to produce it. They even entered into a new agreement with Chile recently that will allow them to mine it for significantly more time. So they are solidifying the leadership position in this market, and they aren't leaders only in that. They obviously vary a lot, but they should be able to make something around 300 to maybe 600 million throughout the cycle. It depends a lot on the capex, as we can see in the past 2 years, but we also have to keep in mind that this company is investing a lot lately. Thanks to the lithium boom, they got a ton of capital on top of what a normal fertilizer company did, so they are investing relatively a lot. They expected about 2.4 billion going into capex from 2024 to 25, a majority of that being for lithium, but also a significant 700 million going into nitrates and iodine. Financially, we see a very healthy position, with the current assets almost covering the total liabilities, which I think is the healthiest balance sheet so far. There is around 5 billion in equity on a roughly 10 billion market cap, so not the cheapest. I think the market might still be a bit optimistic about lithium, and this might be a reason why they value this asset so high. They very recently issued 850 million worth of notes due in 2034 with a 5.5% interest rate, which is actually surprisingly low for such a company. Remember, it's South America, which by default means higher rates, commodities, especially lithium, and being able to borrow at basically the US Treasury rate is quite impressive. They can also produce pretty much everything at very good prices, so it's very likely to see them make decent money in pretty much any environment. And the advantage is that if a commodity is down and another one is up, they can use that extra cash flow to develop the one that is down and buy a competitor or whatever. They get much more flexibility than a classic fertilizer company that only produces that. This is definitely an advantage to keep in mind. The dividend is also varying a lot since it's based on the profit, but overall we can see quite significant yields. If you bought this during the downside in 2019, you could have seen some 25 to even 40% dividends in 2022. This is on top of a 3-4x in not even 3 years, and it's the kind of potential I'm talking about with commodity companies. So again, buying this type of company at the right time, or rather when the margin of safety is good enough, can really pay out. So overall, this is a good company with a very interesting combination of commodities, good financial health, low production cost, good money maker, and so on. I think this is actually in a unique spot right now, both from the perspective of lithium and fertilizers. You have the high potential and high volatility lithium kind of balanced by the much more stable plant nutrition. It's very rare to see this thing in the market because fertilizer companies don't have the high volatility things like lithium, and lithium companies are often exposed mostly to lithium. Combine it with financial health and good profits throughout the cycle, and you have a company that should be able to withstand many commodity cycles and even thrive in them. Plus the potential for huge dividends during the upside with a balanced policy, which I think is optimal for this kind of company. This one is actually on my watch list, and it's an option I'm definitely considering. Now ICL, this is a 100-year-old Israeli company with 43 production sites in 13 countries and global operations. They are a leader in industrial products, phosphate and growing solutions with significant market shares, all of which are and let's say could be even more essential in the future. They make money from bromine, which they can produce a lot and at extremely cheap prices, various phosphates used in anything from food and drinks to paints and batteries, as well as potash and plant nutrition. They can produce the potash at again very cheap prices, being in the bottom 10-15% of the production curve. By the way, sorry for the quality of the images, I think they upload them as JPEGs or something in the presentation and they get compressed. So with this you get cheap exposure to food and vertical agriculture, EVs, batteries, storage, on top of all the classic energy, construction, electronics and so on. This is honestly a very attractive package of commodities that will likely be used for who knows how many decades. They can make something like 600 million now on lower commodity prices, which is not bad for the current market cap. Depending on the capex, they can probably manage to make at least 2, maybe 300 million in bad times and 800 to over a billion in good ones. Financially, they are in a good position with the current assets covering the current liabilities, although they don't have a lot of cash and rely on receivables and inventories. There isn't a lot of long-term debt and the assets cover it more than twice. There is about 6 billion in equity, which isn't bad for such a market cap, which is getting pretty interesting. Now, I guess the main issue is not the volatility of the commodities. That's actually great and it's an advantage in my opinion because we can get opportunities. The risk would come from the operations in Israel, which they also mention in the financial statement. I think this is technically a war zone today, and if it escalates to even more significant levels and the country is attacked, what do you target? Look at what Russia is doing, or at least trying to do. You go for power, water, infrastructure, food and all the essentials. I think this has had an effect on the stock so far and it can degenerate into more. Not to mention that in an emergency scenario, the government can probably restrict what this type of company can do, at least with the local production. But they are very diversified and don't rely on what they make in Israel, so that's a plus, but keep it in mind. But another but, almost half of the company is owned by the country. We can never know how this can evolve and they take it private at a low price or something, but it can also mean support if they need it. They pay a solid roughly 5% dividend, which is actually very sustainable at current prices, and even if they fall, this might still be okay. As far as I could find, the dividend policy and stuff aren't mandated by law in the country, but owning almost half of them can have a massive influence on what they do. I say that because in Russia, for example, state-owned companies must pay significant dividends, and I know there is something similar in Brazil as well. So overall, this is definitely interesting. The package of commodities that they offer and the fact that the company is healthy, makes good money and is able to produce them at very good prices are huge advantages. And they also give a good and currently sustainable dividend on top. I mentioned this in the ADM video and I still believe that you go for ADM if you don't know what other options you have. This is simply a better company from any point of view. Sure, you maybe won't get a dividend every year, but when you do, this can potentially beat 2, 3 or more years of what ADM has to pay, which is a big issue. So overall, this is definitely an industry to keep an eye on. I think it's another way to get exposure to food from a different perspective, and in some cases they can be even better companies than the food producers. This is around the average of the cycle and they are at a key point with rate cuts. The companies are getting to interesting levels, but in some cases the market is not really up to date with the price of the commodities. Again, 2021 and 22 should be seen as outliers and they aren't part of the normal commodity cycle. This is a very slow cyclical industry and because of that you have to be very careful when you buy. If you bought in 2013 for example, you would have made a bit of a profit including the dividends, maybe if you sold at like the peak of 2022. At any other point, including today, it would have been a bad investment. So like any other commodity company, you have to be very careful when you buy, and this is not like a normal company that has linear growth. It's impossible to know what will happen, so I think the best way to go in this industry is by having a huge margin of safety. So let's say maybe 5x the average cash flow, 50% discount to equity, the equivalent of 8 to 10% dividends today and stuff like that. And most importantly, I'd only go for a company with good financials that can survive a bad environment for more than enough to see it recover. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.